This is Kenny Tian. Welcome to Real Estate License in 14 Weeks. This is episode 18 of Starting from Zero. We continue on chapter 5. This time we're going to talk about different loan provisions. If you like my video, please give me a thumbs up, subscribe to my channel, hit the bell so that you can receive first notification of future releases, and then share this video with your friends. We're going to talk about what is due on sale clause or alienation clause. Due on sale clause is the same thing as alienation clause. What it means is that it's a loan provision that prevents a transfer of property before the loan is paid off. Say, for example, a father bought a house and then there was a loan on the house. And before the loan was paid off, he decided to quitclaim the property to the son. Now the question is, how does that trigger the alienation or due on sale clause? Technically, the transfer from the father to the son is not a sale, but just a transfer. So a due on sale clause doesn't mean that it's only triggered when there is a sale. No, all that means is it will be triggered whenever there is a transfer. For example, if an individual bought a property under his own name and got a loan, and later on he decided to transfer this property to his corporation, well, technically that will trigger the due on sale clause because it is a transfer. If the lender wants to insist on the due on sale clause, even in the first situation where the father transferred to the son, or the second situation where the individual transferred to the corporation, the lender can insist on that right. Now, whether or not the lender insists on that right will depend on many factors. Most lenders does not insist on that right as long as the borrower keeps making timely payment of the loan. I have seen cases where the lender actually will insist on a due on sale clause, so you got to be careful about that. So a due on sale clause and an alienation clause will be triggered. When it's triggered, say for example, your monthly payment on the mortgage, let's say it's $6,000. And if you trigger the due on sale clause, and let's say the principal is $1 million, the lender can actually demand the full $1 million is due, even though you may have gotten a 30-year loan and you still have many years to go on the loan. But as a result of triggering the due on sale clause or the alienation clause, the life of the loan is technically shortened, and the lender actually wants to be paid right now instead of years later. There are a couple of exclusions for the due on sale clause or alienation clause. One has to do with death of a joint tenant. Whenever you bought property as joint tenants, the lender actually will allow transfer of property as a result of the death of one of the joint tenants, and then the remaining survivor will get the property. Now that's an exclusion. Also, many lenders will exclude the following situation from the due on sale or alienation clause, such as a transfer between two spouses where there was a community property with right of survivorship. Next, acceleration clause. An acceleration clause is a clause in the note that allows the lender to call the loan due. When the lender calls the loan due, it's almost the same thing as basically what it means. I want to be paid right now in full. How does the acceleration clause get triggered? Usually the acceleration clause is triggered whenever the borrower is in default of the loan by failing to pay the taxes and insurance. Taxes and insurance. For exam purposes, remember, taxes and insurance, if the borrower fails to make those payments, it may trigger the acceleration clause. Okay, that means that the loan is accelerated. What is a lock-in clause? A lock-in clause is the type of loan that prevents an early payoff. It prohibits an early payoff. In other words, if it's a 30-year loan, you cannot pay off right now, because the reason why we have lock-in clause has to do with the fact that some of these loans were actually made by life insurance companies. Believe it or not, life insurance companies actually make loans. So when life insurance company calculate life insurance benefit and life insurance premium, they rely on getting certain income from the loans that they make. So they don't want people to pay off early. That's why they have it in the note that the loan cannot be paid off early. It's called lock-in. It's locked in for however many years the loan is for. Next is called the or more clause. Or more simply means that every month, let's say for example, you have a monthly installment payment of $2,000 for a 30-year loan. Now, if you want to pay more, you may do so. That's why it's called the or more clause. So as opposed to paying the $2,000 minimum, you could pay $3,000. Now, the additional $1,000 that you pay toward the loan is actually paid to reduce the principal, prepayment penalty. A prepayment penalty allows the lender to charge you a fee if you pay off sooner. So in other words, it will allow you to pay off the loan sooner, but you get charged a penalty. It's called prepayment penalty. Let's say, for example, there are some loans that may have prepayment penalty clause for, let's say, within the first couple of years. Let's say within the first 2 years you pay off the loan, you actually may get charged a penalty. That's called a prepayment penalty. But if you wait until 2 years is over, you wait until the prepayment penalty period is over before you pay off the loan, then you don't get charged the prepayment penalty. Most residential loans does not allow prepayment penalty these days. So in the exam, just remember that most residential loans don't allow prepayment penalty. Subordination clause. What is a subordination clause? To explain it, it's easier if I give you an example. Let's say there's a piece of vacant land in San Jose. The vacant land is being put on the market by the owner for $3 million. So a developer comes along. Developer is interested in buying this property because he can use it to develop a big residential project, for example. But he doesn't want to pay the full $3 million on the property unless the seller is willing to subordinate. What that means is the developer negotiate with the seller that the developer, let's say for example, the developer wants to pay 50% as down payment. So the developer will put $1.5 million as down payment, and the remaining $1.5 million, the developer can do a seller financing. Basically, the seller will have a first deed of trust against the property for 1.5. But the developer also needs to get a construction loan, or get a loan from the bank. As you know, most banks do not want to be in a junior position. Now, since there was a $1.5 million deed of trust recorded against the property by the seller, and it is in the first position, in order for the developer to get a loan from the bank for the construction of his project, he needs to negotiate with the seller to allow the lender to go on top of the seller in terms of the priority. Normally, a deed of trust has a higher priority if it is recorded earlier, but a subordination clause essentially is one where the owner of the deed of trust agrees to go below someone else. That's why we call it subordination. Assignment of rents clause. This is very common among commercial loan. Basically, it allows the lender, let's say if you own a commercial property, and on the commercial property there are commercial tenants paying you rent, but you needed to get a loan from the bank. So the bank agrees to make a loan to you on the condition that if you don't make your loan, they can actually go to the tenant and demand payment of the rent from the tenant toward paying the loan, because you don't have the ability to pay the loan. So in other words, assignment of rent allows the lender to receive rent on your behalf so that there is money to pay the loan. That's called the assignment of rent clause. This is the end of episode 18. See you around.